Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video recap where we go over all of the trades that we made here today on Tuesday, August 5th. It was actually a pretty active day. We had one new opening trade, two closing trades for a profit, and then two adjustments to current trades. So very, very active day. Lots of activity in the market, still a lot of high implied volatility, which makes it just really good for options traders. There's a lot of things out there that we can do. So the first one I want to go over is our Iron Condor and Groupon on the weekly options, and this is really an earnings play. And I'll also preface this by saying I got this alert actually late in the day. So this fill actually happened about 2 minutes before the close of the day. So I completely understand that some people did not get this alert because of delays in text messages coming out or emails being delivered. I get it, but as always, I try to send out these alerts as soon as humanly possible. They are linked up directly with my account, so as soon as that trade happens, that alert goes right out. There's no delay in that area. But we only got this alert about 2 minutes before the close. We got the fill and the Groupon trade, so I understand that some people might not be able to trade it. Now here's the setup with Groupon. So Groupon has earnings that are coming out after the close. They've already announced earnings, and we'll look at where they're trading actually right now after they announced earnings. But the setup going into this was that we wanted to trade Groupon as far as earnings are concerned because implied volatility is very high. So this gives us an opportunity to sell a lot of premium. However, as we usually do on here, we usually try to do some sort of a naked strategy. So either naked, like a naked strangle or a straddle, something like that. And I just didn't feel confident with the credit that I was receiving on a lot of these naked options. So if I wanted to go far enough out of the money, the credit just really wasn't there. It was like 30 cents on one end or 15 cents on the other end for just a naked call or a naked put. Not too much as far as premium to really drive out that break-even point. So what we decided to do is do an Iron Condor. Actually, one of the other members inside the area commenting in the membership area had said that they did an Iron Condor, and I hadn't even looked at that until he said that. And so thanks to that guy, I was able to just get this trade in here before the end of the day. So what we did is we did the August weekly, so the front month contract, and we'll go over this in detail. We did the 7-8 on the call side, so sold the 7 strike, bought the 8 strike on the calls, and did the 6-5 on the put side. So again, sold the 6 strike, bought the 5 strike on the put side. In total, we took in a credit of 52 cents, which is actually a pretty decent credit given that the width of each of these strikes is 1, so our max risk is about 48 on each of these condors that we sold. Now, what we did in this case is that Groupon actually traded up to around $7 at the close of the day. So you'll notice that actually our first strike is right here at 7.8. So that really puts kind of a line in the sand right there. And the reason that I did that, again, not knowing where earnings were going to be, is because I feel like this rally into earnings is one of those times when you can buy the rumor and sell the news. So buy the anticipation of earnings, but actually sell the news that earnings may not be as good as everyone expected. With Groupon, implied volatility is so high right now. Everyone is expecting definitely a pretty big move in the stock after hours. And you'll notice that actually the stock actually did move down. So we go to the trade tab here, and you can see that Groupon actually is trading now down after earnings have been released. Stock is not doing well, so that positioning on our end, just kind of positioning for a bearish move, actually turned out to be pretty good. So if Groupon would have went higher, that obviously wouldn't have been such a good move, but in this case, it worked out in our favor. And you can see that the bid and the ask after hours is about $6. So Groupon is trading about $1 lower, which really works in our favor. Now, if we go to the Analyze tab, you can see what the visual chart representation of this Iron Condor is. Again, very similar Iron Condor that you're used to looking at, right? We have our short strike here at 7 on the top side and our short strike on the bottom side at 6. Now, because of the credit that we took in, it moves our break-even point out about 50 cents on either end away from those short strikes. So our actual break-even points are around 750 and 650. Now with Groupon trading right here at about $6 after market, and if this thing opens up tomorrow right around this area, we actually stand to make a pretty good profit, about 120, 140 bucks or so after commissions if we close this thing out at a full profit. So really good trade, very high risk reward trade. Definitely something that we want to get more into. Just didn't like the call spread, or didn't like the naked calls and the naked puts. But again, the Iron Condor looks like it might be working out. Okay, so trades that we closed out of today, there is MON and POT. Both of these are calendar trades that we have made. Now, as always, if you go back in some of these video tutorials, and especially members who are on the website here, you can go back in the video tutorials just by clicking the playlist in the top left-hand corner of the screen. So once you highlight the video, you'll see that in the top left-hand corner. Go back to all those video tutorials. When we actually made these trades, implied volatility wasn't really that high. So as implied volatility for the overall market has continued to rally, and as these stocks have kind of settled in right around the strike prices that we're trading on these calendars have started to really expand. So these are actually working out really, really well. A lot of the calendars that we're trading are actually doing very favorable. These two are two of the kind of leading pack. So we want to go ahead and close those out with a nice little profit heading into the rest of the week. For MON, which is Monsanto, we sold back our September, August 115 put calendar. So again, everything centered around 115. Sold that back to the market for $130 credit. Took in a nice little profit of $36 on that one. Again, there's a one lot trade for Monsanto, so not a big trade, but again, it really was great that we saw the stock even move a little bit after we made the trade, kind of trade below 115, now rally back up to 115, and you can see that implied volatility has gone up since we actually entered the trade. So we're going to take this thing as we get it, right? I mean, that's market closed right exactly at our strikes. I don't think that between now and expiration, the markets can trade exactly sideways. So this gives us a great opportunity to take money off the table, right? Everyone always asks, when do you close out the trades? When do you, look to exit? Well, with calendars, as you get more time and as you start to develop a little bit of a profit, if the market is trading right at your strike or right at the strike that you need, in our case, 115 on the put side, then take what the market gives you. It's now traded, about 8 or 9 days. It's had time to decay. Implied volatility has gone up, so everything has worked in our favor. Let's not be greedy and assume that the market's going to trade dead sideways from now until expiration and we get kind of a full max profit out of this thing. Same thing happens with POT. So POT is a very similar situation. Sold back to the market our August-September 35 strike put calendar spread. Sold it back for a 45-cent credit. Made about $16 on each of these, but again, we traded 5 of them, so you do the math. Very nice little trade for us as far as a put calendar spread. If I go to the chart of POT, you can see very, very similar thing happened. A lot of implied volatility, so the stock started to rally down, continue to rally down. That's what we wanted. We were anticipating just a little bit of a move lower as we head into August and expiration time, and you can see the stock closed pretty much right at our strike that we were pinning. So the market gave us what we wanted. It stayed here for a couple days. Let's not get greedy and assume that it just stays right here all the way through expiration, right? So we went ahead and took this trade off again for a nice little profit. All right, so on to the adjustment trade. So we made 2 adjustment trades. One is in LinkedIn, which I did talk about the other day. So I actually had talked about LinkedIn the other day or over the weekend as far as the adjustment that we were going to make, and that was selling a strangle in LinkedIn. Now, I made almost the exact trade that we had looked at, and with LinkedIn, we still have our short call put spread. And the reason that we're going to keep that is because that actually gives us a little bit of downside exposure. So if LinkedIn does move lower, it actually helps us out just a little bit if that call spread can actually start to make a little bit more money if LinkedIn obviously continues lower. But at least at the current time, what we want LinkedIn to do is trade anywhere between 215 and 190 because we're selling a very wide strangle on this, but taking in a nice big credit. So with LinkedIn, we sold the 215 calls, went ahead and sold the 190 puts. Together with selling both of those, we took in a nice big credit of 270 for LinkedIn, and that helps reduce our break even and our loss on LinkedIn if LinkedIn stays up here. That's the whole idea of this, is that we're not trying to make a profit on this. We're trying to reduce our loss exposure and bring down our maximum loss. So you can see LinkedIn has just popped higher, and what we're anticipating is that hopefully it stays between 190 and about 215 between now and expiration. So expiration is this dotted red line on your chart. So we just need LinkedIn to stay between these bounds here between now and expiration, and we'll definitely reduce our max loss. What it looks like on the Analyze tab, if you guys want to look at that, is you can see here that we have what looks like a very similar strangle, right? Except for this area over here, which has our embedded call spread in it. So it has kind of this weird little hump or weird little mountain on the left side of the chart. On the top side, we don't have anything except for our short call at 215, so very, very similar to a naked option on that side. But down here, you can see that as LinkedIn moves lower, we actually lose money until about 180, and then between 180 and 175, we make back a little bit of money if it does move that far, obviously. But our whole idea here is that we want LinkedIn to definitely trade between about 190 and 215, and that should be a good range for LinkedIn. There's about a 68% chance that by expiration, LinkedIn is trading inside this light blue area, which is about here. So there's about a 70% chance that LinkedIn trades inside this area, and our profit, not our profit window, but our window that we actually want LinkedIn to trade in is right inside that window as well. So very good adjustment to this trade. It's a great example of how to make an adjustment to something like this after earnings. If you're going to play something like we did in earnings, we made definitely a one-sided bet to this, very similar to what happened in Groupon, except we're actually on the wrong side of this bet. So we want to do as much as we can to reduce the potential loss of this trade going forward. All right, and then the other adjustment that we made today was to our Goldman Sachs calendar spread. So with the Goldman Sachs calendar spread, we wanted Goldman Sachs to rally higher, and we had anticipated that it would go up to a strike price of 180. So we had the August-September 180 call calendar spread, and with the overall market, a lot of banking stocks, in particular Goldman Sachs, has continued to rally lower. So what we did here today is we rolled down just the August. So we did not touch the September long 180 calls. Again, we did not touch the September long 180 calls. And all we did was roll down the August call from 180 to 175. Now, how we physically did this, or the actual mechanics of the trade, is that we sold a vertical spread. And we sold the 175s, so we're now short the 175s, and we bought back the 180s. Now, by buying back those 180s that we were originally short, we close out that side of the trade. So however you want to think about it, we originally closed out this side and then re-entered this side normal, whatever you want to do to justify how you mechanically put in this trade, but you can actually do it with a vertical spread, and we're basically rolling down their 180 calls to 175. So now what we have is we're short the 175 August calls, and we are long the 180 September calls for Goldman Sachs, which basically gives us a diagonal spread. And you can see this is what the diagonal spread looks like for Goldman Sachs, and see that actually we still want the stock to rally just a little bit. It would be ideal if Goldman Sachs actually rallied up to right around 175 between now and expiration. That would give us a nice little window to actually take a profit on this trade. But if it doesn't, and this is what we're trying to adjust against, if it doesn't rally up higher, then we want to reduce our loss, right? We want to, take back some of that premium that we're outlaying with this calendar. Had we done absolutely nothing with this trade, we would have had a much higher loss than we could potentially have here, given that Goldman Sachs has continued to rally lower. If we go to the charts and we just start talking a little bit about why we made this adjustment now, you can see that we're a little bit range bound in as far as our timeline is concerned between now and August expiration, right? We want the stock to be, by August expiration, which is this dotted red line, up here at 180. And you can see that's a pretty big jump. So at this point, given that the stock has really kind of fallen off the bed here, this is a pretty huge jump for the stock to make in the next 9 or 10 days. So by making this adjustment, we're kind of forcing the market to even make it just a little move higher to 175, and gives us a better opportunity to make money versus having the stock move all the way up to 180, which is obviously less likely than going to 175. So as always, I hope you guys really enjoyed these videos. It was a really good day as far as trades. Had a lot of trades that we still wanted to enter but just couldn't get any fills. And so we'll obviously try to enter some more of those trades tomorrow morning at the open. As always, if you guys have any comments or questions, please ask them below. If you're watching this video somewhere else publicly on YouTube or online, you just have to understand that you're getting this video about 15 days after it's sent out to our members. So all of these alerts and this video are sent out the same day, only if you're a member at OptionAlpha.com. So you got to go there and sign up for our free trial. As always, happy trading.